Hey, my name is Max Bennet, and in today's TED Talk we will be talking about accounts for receivables and necessary methods of uncollectible receivables. The accounts receivable is the amount of money owed by a customer who has purchased the company product or service. The amount of cash that the company expects to collect from its total accounts receivable is the net realizable value. However, issues arise from bad debt expenses and the inability to collect accounts receivable called uncollectible receivables. When a customer account is identified to be uncollectible, it is written off through various methods. The first is the direct write-off method, which is the simplest method in which bad debt expense is documented when a company concludes that a receivable is uncollectible and removes it from their account and records it as a bad debt expense as an amount receivable. Secondly is the allowance method, which allows the individual to split the transaction into two entries, where one records an estimate of bad debt expense and the other is to write off receivables when it becomes uncollectible. These methods similarly recognise the bad debt expense account and the need to write it off. So the direct write-off method, we use debit bad expenses and credit account receivable. However, this method violates GAAP principles, with the only exception being when bad debt expense is immaterial to the company. Contrastingly, through allowance method, we recognise bad debt through debiting bad debt expense and crediting allowance for doubtful debts. Then we debit allowance for doubtful debts and credit accounts receivable. To effectively match expenses from the uncollectible receivable, we must recover the allowance method by debiting the accounts receivable account and crediting allowance for doubtful debts, ultimately covering the write-off. Consequently, we must estimate the bad debt expense. This is done through the sales receivable and aging of accounts approaches. The first is the percentage of sales approach, in which the bad debt expense matched to a company's sales for that period of time. For example, $100,000 of 5% uncollectible receivable would give a bad debt expense of an estimate of $5,000. However, there is no consideration given to the resulting balance, thus given a less meaningful net realization. The second approach is the percentage of receivables approach, which contrastingly results in a very meaningful net realizable value. This is determined through the closing balance and is worked out through bad debt expenses as a set of percentage receivables in the T account. For example, a company with 24,000 receivables expects 2% to be uncollectible, estimating $480 of bad debt expense. The next step is to adjust either a bad debt or a credit balance. Debit indicates a greater write-off during the year than expected, and credit indicates write-offs have been less than expected. If a company has a $100 credit prior to adjustment, to get a balance of $480, credit requires an additional $380 credit entry. The last approach is the aging of accounts receivable, which organises accounts receivable by their time periods and age, and becomes less collectible as age increases. Receivables outstanding longer than 30 days are considered past due and are grouped together in 30-day increments. Thanks for listening, guys.